rupee plunged to an all-time low of rupees 91.7425 against the US dollar, recording its biggest single session fall in 2 months. Well, this marked the 6th consecutive day of losses, with the rupee closing at rupees 91.6950. That is down from rupees 90.9750. Traders said that the decline was exacerbated by the Reserve Bank of India staying away from the market, failing to provide adequate dollar liquidity. The rupee has been the worst performing Asian currency, that is, down 2% in January and about 5% over 2025. Well, let us understand about the global factors and geopolitical pressure which has affected it. The slide reflects broader global uncertainty, including a bond market rout and geopolitical tensions related to US actions in Greenland. Persistent foreign fund outflows have also weighed heavily on the currency. However, the rupee partially rebounded by 15 paise to rupees 91.50, following positive signals from global markets. US President Donald Trump's announcement at the World Economic Forum in Davos that he would not impose tariffs on 8 European nations eased geopolitical concerns and improved investor sentiment. Well, what has been the impact on Indian stock markets? Notably, the Indian stock market faced heavy losses amid rupee depreciation. On Wednesday, the Sensex fell 0.3% and foreign investors pulled out rupees 15 lakh crore from Indian equities over the past 3 days. In January alone, foreign institutional investors have withdrawn nearly $3 billion, adding to the strain. Experts note that continued volatility could persist until global risk sentiment improves, though RBI intervention may help contain extreme swings. Well, what has been everyday impact of a weak rupee on our daily lives? Notably, a falling rupee affects households and businesses directly. Let us break it down. Number 1, rising import cost. Oil, electronics, and raw materials priced in dollars become more expensive. Number 2, foreign travel and education. Air tickets, accommodation, and tuition fees abroad require more rupees, straining budgets. Number 3, inflation risk. High import cost can gradually feed into consumer prices. While exporters may see short-term gains due to the improved competitiveness, most Indians experience higher cost and reduced purchasing power. Well, what has been government and leadership perspectives on this? India's economic performance under different leadership tenures provides context for current vulnerabilities. During the Manmohan Singh era from 2004 to 2014, the economy saw average GDP growth of 7.7%. That is strong stock market returns, that is 15% annually, but higher inflation, that is 7.5%, and trade deficits, that is $100 billion. Policies focused on growth through liberalization, foreign investment, and expanding access to services. And meanwhile, on the other side, enduring Narendra Modi's tenure from 2014 onwards, average GDP growth stands at 6.8%. Retail inflation around 4.8% and trade deficits reduced to $70 billion. The GST, Make in India and fiscal reform strengthened tax collection, that is tax to GDP ratio, and improved fiscal discipline. However, stock market returns average 11%, affected by global volatility and domestic policy shifts. And the rupee's current weakness highlights that even under Modi's administration, global factors, foreign fund flows and import demand can create stress on the currency despite structural reforms. Well, what has been the outlook for the rupee? Analysts suggest that the USD-INR pair may consolidate between rupees 91.30 and rupees 91.60, with support around rupees 90.80. A breach above rupees 91.80 could push it towards rupees 92.50, while a drop below rupees 90.80 may trigger corrections to rupees 90.50 or even 90 rupees. Experts emphasize that the rupee's fall is mainly driven by global sentiment rather than domestic economic weakness, and careful monitoring by the RBI, along with stabilization of foreign inflows, could contain extreme volatility. Notably, the rupee's historic slump underscores the interconnectedness of global markets, domestic equity trends, and leadership policies. While Narendra Modi's structural reforms have strengthened the economy, persistent global shocks, foreign outflows, and import pressures continue to challenge currency stability. And in contrast, Dr. Manmohan Singh's era achieved higher GDP growth and stock market gains but faced higher inflation and trade deficits, showing that every administration faces trade-offs between growth, stability, and structural reforms. That's all for now. Stay tuned to the Savera for more updates. Do like, comment, and subscribe to the channel.